Joseph, can you explain to us what is LIBOR, what is SOFR, where are they based off? And I know that you had these like great slides that you have presented before, and how it all ties in with like 10-year treasury and repo markets. Yeah.
Yeah, so LIBOR is basically, for the most part, for many decades, the global standard in dollar interest rates. When people are talking about like a rate that has credit risk, they're talking about LIBOR. That's why it appears on all your contracts. In the beginning, LIBOR was basically a rate for banks in London. So if you're a big bank in London, what they would do is they would ask a panel of them, what if you had to borrow in the dollar markets, what interest rate would you pay? And they take a panel of all these banks, take their self-reported rates together, lop off the extremes, and you'd have LIBOR. And that was basically a benchmark rate of where a big bank would borrow if they needed to borrow dollars in unsecured market. That rate became extremely influential. It was not used not just in commercial real estate, but it was also used in corporate debt and in all sorts of kind of benchmarks. During the great financial crisis, there became some concern that maybe LIBOR was not a reliable rate. There were some reports that perhaps some people in some banks were submitting LIBOR in a way that was not straightforward, and they were doing so to benefit themselves. For example, there were reports that some banks were submitting a lower LIBOR than they should have because they had other positions, derivative positions, that would benefit from a lower LIBOR. So they were getting together and kind of, I guess, reportedly manipulating this rate. And so the official sector, let's say the Fed, not just the Fed, but the global regulatory committee, people in the Bank of England and people, let's say the BIS, they all felt that this was a less reliable rate. So they wanted to reform LIBOR to make it into a rate that was more trustworthy. And the Fed went about trying to figure out what kind of rate do they want to be a reference rate. And after a lot of discussion, what they landed on was SOFR, which is a repo rate. And in a moment, well, actually, I'll just tell you what repo is. Repo is basically a secured loan that's backed by a treasury collateral. So for example, if I had a 10-year treasury security worth $1 billion, I could repo that out into the repo market and get a cash loan with that collateral. Technically, it's called repo because the way that the secured loan is structured is that you sell that treasury to someone simultaneously with a promise to buy it back, let's say the next day, at a slightly higher price. That slightly higher price is what's considered the interest of that loan. People like repo because under bankruptcy law, it's a bit more creditor friendly. If you do a secured loan, a proper secured loan, and then the person you lend to goes bankrupt, then you end up in bankruptcy court under the automatic stay, then you're stuck. You're going to have to go to bankruptcy court, and it's expensive and you have to wait for things to pan out. But if you do a repo transaction, you walk away with the collateral, so it's easier. So lenders like to do repo loans. Now, the repo market is a ginormous market. So just in the US, just private sector repo is about $3.5 trillion a day. Now, SOFR, which is a subset of that, is $1 trillion in private transactions every day. So it's a very, very deep market. And if it's a deep market, it's a market that's very difficult to manipulate. Now, another big difference is that SOFR is done with real transactions. LIBOR, like I mentioned before, was just a group of the banks just reporting what they think they can borrow at. There's no real transaction under it. And in fact, the actual transactions that banks do every day is very low. Say, every day you come up with a LIBOR rate, that's the bank reporting what they can borrow at. But the actual borrowing done by these banks is maybe about 30 billion a day. So you're going to have this entire universe of loans based on a reference rate when the underlying transaction volumes are very small. SOFR is completely different. The treasury repo market, $1 trillion a day. So it's impossible to manipulate. So that's why the Fed chose it. They felt that it was more secure. But more importantly, though, it's a market that the Fed controls completely. Now, LIBOR, as all you've seen, for example, during 2020, LIBOR can do all sorts of things. It can spike higher, and then it can suddenly move very lower. It can be volatile. Fed doesn't have a lot of control over LIBOR, but SOFR is a whole nother matter. SOFR, the Fed can control very well. It does so because it has two tools to control SOFR. It has something called a reverse repo facility, actually, I'll just make it easier. Because the Fed is willing to lend and borrow in the repo market in basically infinite quantities. So if the rate, if SOFR gets too high, the Fed will come in and be willing to lend infinite amounts of money into SOFR. That keeps a ceiling on it. And if if SOFR is too low, the Fed will step into the market and be willing to borrow infinite quantities of it. So that means that anyone who's willing to lend, who can just lend to the Fed. So that puts a floor on rates. So this for the private sector, moving to SOFR has the benefit as just cutting out a lot of the tail risk. So, if you're borrowing with LIBOR, it could spike. SOFR can't spike. So that's one benefit there.
So it's kind of like it allows the Fed to kind of potentially manipulate that rate. It could be more stable. You would guess the Fed want to stabilize these rates, but it kind of turned it into a little bit more of a big government control rates.
Absolutely. So
yeah.
I
So do
would
you
take
see
a
some
step.
side effect to that?
I would, well, so here's the thing. Let's say you're making a LIBOR loan. And so think about the SOFR. So LIBOR and SOFR, big difference. LIBOR has credit risk. SOFR does not have credit risk. Because if you're lending against treasury collateral, you don't have credit risk. It's a risk-free rate. So let's say bad things happen. That's why LIBOR goes higher. That's why SOFR goes lower. So that's a good thing for you. However, if you're a lender and you know that this is how it works, then, beforehand, you might add a slightly higher spread to LIBOR, to your SOFR loan, because you know that if something happens, SOFR is not going to go the direction you want. So let's say you're a lender lending based on SOFR and there's another COVID panic or something like that. Your risk increases, right? But SOFR is going to go lower. So keeping that in mind, maybe you might want to increase your spread over SOFR at the beginning. So I think this is all new, so it's not clear how people react yet. But you made a really good point, though, about whether or not this is manipulated rate, and it absolutely is. But here's the thing, though, all short rates are manipulated. So when you look across the rate universe, I would divide it into a couple segments. The first would be the short rates, which includes SOFR, let's say up to like 5 years. And then in the middle, 5 to 10, and then 10 and beyond. Within 5 years, those rates are all set by the Fed. And the Fed is able to set this rate because it's willing to borrow unlimited amounts of money at whatever rate it wants. So today, let's say the rates are around zero. The Fed is willing to borrow basically unlimited money at zero. When the Fed raises rates, let's say it raises it to 1%, then the Fed says, I'm going to borrow money in unlimited quantities at 1%. When the Fed does that, all the private investors say that, I can either lend to the Fed at 1% or, I don't ever have to lend below 1%. So that's how the Fed controls short-term rates. Now, I say 0 to 5 years because there's an expectation of how the Fed will move their overnight rate, right? So if this Fed says, I'm going to keep rates to zero for like 2 years, then for rates 2 years out, everyone believes the Fed. And that means the 2-year rate is going to be around zero. So the Fed has a lot of control over the first 5 years, and they are completely manipulated, and they've always been. The longer dated rates, let's say beyond 10, that's not really controlled by the Fed. The Fed has to do that indirectly. The way that they try to do that is for tools that we've all heard of, like quantitative easing or mortgage purchases.
Yeah. Can you explain these terms a little bit more for our listeners over here?
Of course. So what happens? So in the short-term rates, the way the Fed controls short-term rates is basically offering to borrow unlimited quantities overnight, right? And being able, and because the market participants have a view as to where that overnight rate will be over the next few years, they can easily price rates up to, let's say, 5 years. Beyond that, no one knows. So let's say rates are at zero, and the Fed says, I'm really worried about the economy, but my rates are already at zero. I'm not going to do negative. How do I stimulate the economy?
Right.
So what the Fed ends up doing is they're thinking, I want to make, let's say, 10-year rates go lower. I want to make mortgage rates go lower.
Right.
How do I do that? I just buy a lot of treasuries. I buy a
Mm,
lot of agency MBS. And when the Fed buys this, the prices go higher, as all of you know, then the yield goes lower. And that's what they've been doing for the past, since the post GFC world.